Hi, so today I want to discuss the holy grail of investing, which is diversification. So a lot of people actually they have different opinions of what diversification actually means, but this graph from Ray Dalio I think explains it really well. So if you look at the number of assets, so it's the X axis there, so horizontal line, it goes from 1 to 20 really, and if you bought the more uncorrelated assets you bought, the lower would be your standard deviation on the vertical line. So standard deviation investing is considered equal as risk. So that basically means is how much more volatile an investment can be. So as you can see, the more assets that you have, the lower the standard deviation in your portfolio will be. And the more correlated those assets are, the higher that standard deviation will be. So the more risk it is. So let's take the first line as an example here. So you've got here. Let me just get a laser pointer, right? So you've got the first line with one asset would bring a 10% risk. That means that the asset in a given year can vary -10 to +10%. So it's a really high variation. And if you're planning on retiring soon, so that is not a variation that actually you can afford. But the more you buy assets, the more that risk is reduced. But there is a third variable there, which is the correlation between those assets. So if they have 60% correlation, then it would be the first curve. 40% correlation would be the second curve. 20% correlation, the third curve, 10% correlation between assets, the fourth curve, and then 0% correlation between assets, which is incredibly difficult to achieve, would be the fifth and last curve. And then you can see that those correlations they usually mean by a certain period of time. So for instance, let's pick up this portfolio and look at a 10-year lifespan, which is a pretty considerable and reliable source. Let's say that you've got a 60% correlation. So basically, the probability of losing money in a given year would decrease by quite a good amount in terms of percentages the more assets that you have. But another incognito that you can move on and really play with that variable is the correlation. So how do you actually think about correlation? Well, things that wouldn't be affected together. So for instance, the airlines business would be very far from the food and drinks business. The only way that they play together is when the airlines sell food and drink to their customers. But that is not very strong. Or let's say the Brazil economy is not really influenced by the Australian economy. So those are quite uncorrelated assets. However, the Brazil economy would be very influenced by the China economy and by the American economy because their exports and imports will be highly interconnected. So that is the way of thinking about it. And then I wrote a blog post on the reason why, for instance, you should have a investments in abroad, and that's quite a good moment to review some of the aspects here. So, for instance, here is the annual GDP growth per hour worked over the last 5 years. So you can see that in the developed economies, actually, GDP per hour is decreasing significantly because their population growth rate is almost zero. So if you look at Japan, is actually declining. Germany, 0.3% population growth rate. UK 0.6%, but 80% of that growth comes from immigration. US 1%, but most of that growth also comes from immigration. France 0.2%. So the population growth rate there is very, very low, and that contributes to the GDP per hour worked being very, very low in those countries. So those countries, they are almost reaching their maximum growth, and it brings a period of stagflation. Is the last 25 years that we've seen Japan, for instance, they haven't grown a single bit. They grow a little bit and then they decline, and they stay around that 0% GDP growth rate for the last 25 years with zero to no inflation. So there isn't much growth. So that's why when thinking about diversifying your portfolio, you also want to include diversification into emerging economies, because that's where the population growth is coming from. So the world's current population growth is about 1%, and that is predominantly driven by the African countries. So they are bringing the most population growth. But there is also something to be said about the Chinese economy, as well as India economy, because those countries are really, really doing a great job. So let's check out, for instance, the tendency here on the emerging countries and developing countries. You can see there is an ascending trending line from the 80s up to now, and it is due to continue that way. So from the 80s, they were about 3% average GDP real growth, and now they are almost achieving 6% average per year GDP real growth. Whilst the advanced economies, they were about almost short of 4%, and now they are really 1%. With coronavirus, obviously things they look even worse, but with the recovery from the virus, they should look like that. So that's why whenever creating your portfolio, you want to look at, you know, um, going from cyclical industries such as automobile to non-cyclical industries such as staples, food, chocolate manufacturers, for instance. Then you want to look at emerging economies to developed economies. So, for instance, myself, I have investments in China index fund, US index fund. I have Brazilian bonds that pay more. So you want to diversify to reduce your risk and also increase your alpha in your portfolio. And then, last but not least, you another thing that I want to show is that how well those different portfolios they actually work depending on the current stage of economic growth and inflation. So on the left hand side, you can see that when there is high economic growth and low inflation, stocks perform really well, corporate bonds perform really well, commodities such as gold perform really, really well. When there is high inflation but low economic growth, then gold performs really well, and inflation-linked bonds performs really well. When there is low economic growth and low inflation, is called deflation period. And then treasury bonds and inflation-linked bonds will work really well. And when there is low economic growth but high inflation, that's called hyperinflation period, then treasury bonds and stocks will perform well. So you can see that it's also important to have diversification within assets, because depending on which economic growth you're dealing with and which inflation you're dealing with, then different types of assets will perform differently. So that's why you want to bear in mind diversification, and you want to bear in mind why to invest abroad.